Hello everyone, welcome to Pinstock, a YouTube channel dedicated to trading accuracy and risk management. Today we will be talking about screeners. This will be a series in which we explore screeners. Have you ever wondered how some traders seem to have a knack for picking out the best stocks? They might be using something called a stock screener. This powerful tool, my friends, is a game changer in the world of trading and investing. Imagine having the ability to sift through the overwhelming amount of data in the stock market and pinpointing the exact stocks that meet your specific criteria. Sounds like a dream, right? Well, that's exactly what a stock screener does. By setting parameters such as price, sector, market cap, and many more, you can effectively filter out the noise and zero in on stocks that hold the most potential. Now, think about the time and effort you'd save, not to mention the increase in your chances of making profitable trades. So in essence, a stock screener can be your secret tool for identifying successful and active trades from a vast pool of stocks. Ever thought about having a secret tool for trading? Now, you might be thinking, why does stock selection matter so much? Well, let me tell you, it's like picking the right ingredients for a recipe. If you choose the wrong ones, your dish might not turn out as you expected. Similarly, poor stock selection can lead to underperforming investments. Imagine investing your hard-earned money into a stock, only to see it underperform while another from the same sector skyrockets. Yes, it's frustrating. This situation can be significantly improved by careful and informed stock selection. Remember, the stock market is a vast ocean teeming with potential opportunities, but not every stock is a pearl. Some are simply rocks. Being able to identify the pearls from the rocks is what differentiates successful investors from the rest. So, don't underestimate the importance of stock selection. It's a critical skill that can significantly impact your trading and investing journey. Choosing the right stock can make all the difference between a profitable trade and an underperforming one. Ready to cook up some profitable trades? So, what should you be looking for when screening stocks? The answer to this question is a blend of science and art. Stock screening is not a one-size-fits-all approach. It's a process that requires careful thought and consideration of several key factors. Let's delve into these critical elements. First and foremost, consider the company's market capitalization. This is the total value of a company's outstanding shares of stock. It's a key indicator of a company's size and stability. Larger companies tend to be more stable, but they may offer lower growth potential compared to smaller emerging companies. Next, look the price-to-earnings ratio, or PE ratio. This measures a company's current share price relative to its per-share earnings. A high PE ratio could mean that a company's stock is overpriced, or it could indicate that investors are expecting high growth rates in the future. On the other hand, a low PE ratio might indicate that the company is undervalued, or perhaps that the company's earnings are expected to decrease in the future. Then consider the yield. This is the ratio of a company's annual dividend compared to its share price. Dividend yield is a factor for income-focused investors. A higher yield may indicate a good income-generating investment, but it could also be a sign of a company in distress. Also, take into account company's debt-to-equity ratio. This measures how much debt a company has compared to its equity. A high debt-to-equity ratio might indicate that a company has been aggressive in financing its growth with debt, which could pose a risk if earnings don't pan out. Finally, examine the company's earnings growth. This is the percentage change in the company's net income over time. It's a key indicator of a company's profitability. A company with consistent earnings growth is often a good investment, but it's important to consider this in conjunction with other factors. Remember, the key to successful stock screening is understanding and correctly interpreting these factors. It's about more than just numbers. It's about understanding the story behind those numbers and making informed decisions based on that understanding. So, feeling like a stock detective yet? Now that we've got the basics down, let's explore the different types of stock screeners out there. There's a whole world of options, each designed to cater to a specific need. First, we have fundamental screeners. These are for the long-term investor. They filter stocks based on fundamental analysis metrics like PE ratios, dividend yields, or revenue growth. Next up, technical screeners. These are the darling of day traders and swing traders. They focus on chart patterns and technical indicators like moving averages or RSI. Lastly, we have options screeners. These are specialized tools for those options contracts. They can filter based on strike price, expiration date, and implied volatility, among other things. Remember, there's no one-size-fits-all here. Each type of screener serves a different purpose, so it's crucial to choose one that aligns with your trading or investing strategy. So are you excited to explore the world of stock screeners? You've got your stock screener ready. Now what? Well, it's all about setting your parameters effectively and interpreting the results accurately. First, determine the specific criteria that are important to your investment strategy. This might include factors like market capitalization, price-to-earnings ratio, dividend yield, or debt-to-equity ratio. Remember, the power of a stock screener lies in its ability to filter through thousands of stocks to find those that meet your unique requirements. So be precise and purposeful in setting your parameters. Next, run your screener and examine the list of stocks that meet your criteria. Now, this can be a bit overwhelming. You might see dozens or even hundreds of stocks on your list, but don't fret. This is where the real fun begins. My new favorite thing to do is to dig deeper into each stock. Look at the company's financials, read recent news articles, and try to understand the company's future prospects. Keep in mind that a stock screener is just a tool to help you narrow down your options. It won't tell you whether a stock is a good investment or not. That's where your research and analysis come in. Oh yeah, and there's one more thing before I forget. Make sure you continually update and refine your criteria as your investment goals evolve. The market is dynamic, and so should your investment strategy be. Now, what if you run your screener and no stocks meet your criteria? Well, that could mean your criteria are too restrictive. It's always a good idea to play around with your parameters to see how changing one factor can impact your results. And that's how you use a stock screener filter through the noise and find potential investment opportunities. This tool can be a great asset in your investing toolbox, helping you focus on the stocks that truly align with your investment strategy. So go ahead, set your parameters, run your screener, and dive into the exciting world of stock research. It's a journey that can lead to rewarding investment opportunities. Ready to embark on a rewarding investment journey? While stock screeners can be incredibly useful, they're not foolproof. Here's the #1 mistake. New traders often rely solely on the screener results, neglecting further research. It's akin to a car based only on its color. You wouldn't do, would you? #2, my new thing to caution against is overlooking the importance of diversification. A stock screener might show a group of stocks performing well, but remember, it's never wise to put all your eggs in one basket. Oh yeah, and there's one more thing before I forget. The biggest mistake I see is traders ignoring the market context. A stock might look great in isolation, but it performing compared to its peers? If you're worried that you've been making these mistakes, just remember, it's never too late to learn and improve. Avoiding these mistakes can help you make the most of your stock screener and improve your investment decisions. So, are you ready to dodge some common stock screening pitfalls? So you've run your stock screener and have a list of potential stocks. What now? Let's dive into the heart of the matter, analyzing and interpreting our stock screener results. Firstly, we'll need to understand that the results from a stock screener are not an end in themselves. They are, in essence, a starting point, a launch pad for further investigation. It's like having a map with X marking the spot, but you still need to dig for the treasure. Next, we'll need to take a closer look at the financial health of the companies listed. This could mean examining their balance sheets, income statements, and cash flow statements. Are they profitable? Do they have a healthy amount of cash on hand? Are they riddled with debt? These are all questions we need to ask. Also, we can't ignore the importance of industry and market trends. If a company is in a declining industry or facing stiff competition, it might not be the best bet regardless of how attractive it might look on paper. So let's keep our eyes wide open. Now, if you're like me and enjoy finding an undervalued gem, you might want to consider the price-to-earnings ratio, or PE ratio. This gives you a sense of whether a stock is over or undervalued compared to its earnings. Lastly, we need to consider diversification. This is not just about spreading our eggs in different baskets, but about choosing baskets in different fields. In other words, we should aim for a mix of stocks from various sectors to protect against sector-specific risks. Oh yeah, and there's one more thing before I forget to tell you. always remember to consider the risk associated with each stock. This could be in the form of volatility, which is the degree to which a stock's price fluctuates. Higher volatility often means higher risk, but it can also mean higher potential returns. So, balance is key. Remember, a stock screener is just a tool. It's up to you to analyze the results and make smart investment decisions. So, go forth, analyze, interpret, and may your investments be fruitful. In our next video, we will start with TradingView.com screener. Until then, subscribe to our channel and hit the bell icon for regular updates and alerts from Pinstock. Happy investing!